Hello friends, welcome to learning sessions, and today in this video we are going to discuss about the abfm, very important concepts, and in this particular video these concepts will be turning out to be very fruitful for you because these are going to be there in the upcoming exam of JAIIB 2024. So what are you waiting for? Hit the like button and further do watch this video till end. And if you are coming to our channel for the very first time, and if you have watched our video for the very first time, you can do subscribe our channel and press the bell notification icon so that you get updated whenever we upload the new videos. So let's hurry up and start the session. But wait, let me just tell you one thing, that we have got the free PDFs for you. We are covering all the 9 papers of CIIB and will be providing you the PDFs free of cost related to each and every subject of CIIB. You just need not to do anything, just sign up on our website, that is iibf.info/CIIB. You can also be finding the link in the description box below, and just navigate to the website, sign up over there, and then navigate to the free study material section and you'll be finding all the PDFs over there. We are also covering the full course videos, case study videos, chapter wise previous year questions, mock test, mega mock test, and everything is covered, and that is just more than sufficient for clearing the exam. So what are you waiting for? Just do sign up right now and start preparing for the same, and let's start the session now. So let's start the session over here, and in this particular video we are going to discuss about the source of finance and financial strategies over there. Now definitely whensoever the business is commenced, at that particular pace we just do require the funds so as to run the day-to-day operations and also for the long-term vision achievement of our business over there. Now whensoever the idea of the business comes to our mind, in that particular case we just need to do one thing, that we do need require the working capital for the same. Okay, so for that particular purpose, what is required? The working capital is required over here. Let's just take the example that person A is over here and he is having a business idea related to the furniture, and he just started a new company. Let's say the case it's a private limited company over here, and for that particular purpose, the inception, he just do require the funds over there. He do require the funds for day-to-day operations. For that particular purpose, the working capital is required, and also he does require the funds for the long-term purposes over there, and for that particular purpose he can seek the bonds or debentures or the term loan from the banks over there. So we are just going to discuss each and everything related to it. Just let's look at the theory part of. First of all, it's related to the fact that term finance is provided by the bank and the financial institutions, this particular related to that we are going to debt from the financial institutions over there, which can be used for the long term as well as for the short term. Now whensoever I talk about the short term, I'm just talking about the day-to-day expenses over there. Like for that particular purpose, the businesses can seek for the working capital limit, that is a CC limit or the overdraft limit over there, or particularly for the long term they can go for the loan against property, they can go for issuance of bonds or debentures, which are the debt instruments over there. And whensoever we are talking about the debt part, there is a ratio, that is a DER, that is a debt equity ratio over there. Now what is actually related to debt? Debt is a part that you have particularly borrowed, and equity is that particular part that you own, right? So equity is the amount which is particularly contributed by the person who have basically mooted the idea related to the business over there. Like person A just contributed rupees 10 lakh when he started a new business. So rupees 10 lakh is the capital, and it is a particular equity over there, right? Like in the cases of the public limited company, where the companies can issue the public shares over there, which are basically stock listed companies over there. For that particular case, they are issuing the shares. Now there are investors who have invested into this particular company, and those are the equity holders. Like person A, B, C are equity holders. Those are the true owners of the company XYZ over there, right? And further, the company will not be having any liability so as to return that particular money which particularly has been contributed by way of equity participation by ABC over here, but the money will only be particularly returned when the company will be liquidated after adjusting all the liability parts on the company over there, right? That's a part related to it. And the other one, it's related to it, the company can also be issuing the bonds and debentures. So bonds and debentures are like a debt instrument over there, like companies basically acknowledging the debt, and further they have issued a bond to person Z over there. Now it's let's suppose a case, it's a rupees 1000 bond with 12% coupon. It's having a maturity of 5 years, right? What does it indicate? It indicates that the company will be paying a fixed amount of 12% on the face value, that is 1000, that is 120 rupees for each and every month for next 5 years, and the maturity they are also to pay the principal amount of rupees 1000 over there, right? That's the case related to it, that the company is to pay the amount. But that's not the case in the case of the equity shareholders over there, right? So you must have got a simple idea related to it. Now let's discuss it in detail over here. So term finance is actually provided by the bank and the financial institutions, and there's a norm which I just told you, it's related to the debt and equity ratios over there, which means that how much amount is contributed by the promoters over there and how much amount is borrowed over there. Now finance is actually required so as to run the day-to-day expenses, and further it's related to what is the gap over there, like what amount is particularly contributed by the promoters and what amount is actually required over there. So there's a difference between the same. So working capital is equal to what? Working capital is the amount which is required by the companies for the day-to-day operations over there. Let's suppose the case that we do require the funds of rupees 10,000 on per day basis, and we just do have an amount of rupees 8,000 that we are having in hand, right? And further, what is the gap? Gap is equal to 2,000 rupees, which we are not having right now. That is a net working capital, right? So NWC is equal to what? The definition says it is equal to the amount of current assets which is exceeding above the current liabilities over there, right? So that's equal to net working capital over there, that is actually required, which is required to be financed over here, right? And after that, it's related to the fact that sources of finance and financial strategies, what are those? One, it is related to the fixed capital. We do require the funds for the fixed capital, like I want to purchase a machinery. For that particular purpose, it's a long-term investment. Why long-term investment? Because I'm not going to use that particular fund for a short-term period. I'm going to invest that particular fund in a particular asset which I'm going to use for a very long term, let's say for 1 year, 2 year, 3 year, or any of the time period over there, right? And other one, it's related to working capital. As I told you, working capital finance is related to day-to-day operations, right? If you basically want to convene our day-to-day operations, for that particular purpose, we do require the working capital finance over there, right? And further, let's take the examples for fixed capital. Let's say case I do require the funds for the land, building, machinery, etc. So that's actually related to the fixed capital over there. And when we are talking about the working capital, it's actually related to that we do require the funds for the short term period. Let's say case we want to purchase the raw material, we want to basically pay the wages, or we want to pay the electricity bill, etc. So that's for a short term period over there. That's related to day-to-day expenses over there, right? Now let's have a look at the sources of finance over there. Now we can be segregating the sources of finance on the various category basis over there. First of all, it's related to according to the period over there. Now according to the period, it could be the short-term finance, it could be the medium-term finance, or it could be the long-term finance. When we are going to borrow for a short-term period, let's say up to 1 year only, it's a short-term finance. Like I just told you that we need to pay our electricity bills, we need to pay for wages over there, we need to pay for various expenses that have incurred over a short-term period over there. That's related to short-term sources, short-term particular expenses over there. And what finance types can be there? Like we can take a bank credit limit. Like I told you, we can go for the CC limit, or we can go for the overdraft limit over there, or it could be related to the customer advances. Let's say case we purchased raw material on credit over there, or it could be related to trade credit over there, right? It could be related to the factoring services. Factoring services basically where a factor comes in the picture, and further you have basically done what? You have assigned the book debts to the factor over there, and in return they have paid the amount to you, right? And it could also be the case that you have issued the short-term money market instruments, commercial papers over there, right? And the other one, it's related to the medium term finance. Now what do you mean by medium term finance? That particular term finance which is basically for a longer period than the short term period over there. Like we just do require the funds for 2 years, 3 years, 5 years. Okay, so that's related to medium term finance over there. For that particular purpose, we can do issue the preference shares. We will be learning in detail about what are the preference shares, what are the debentures, etc. So it's actually related to for the medium term period over there. And the other one, it is for long term period over there. Like we are issuing the equity. Now equity is basically will be there till the company is liquidated. So it's for a very long period over there. Like debentures are issued, like plowing back of the profit. Plowing back of profit means what? That we made a profit, let's say, of rupees 20 crore in the year, right? And further, rather than distributing all the profits as a dividend, we just basically plowed back some of the profit. We just kept aside rupees 12 crore for company development, etc., and for the different purposes, etc., right? And further, we issued a dividend of amount rupees 8 crore only. That's actually related to what? Plowing back of profit. And also it could be the case that you have taken a long-term loan from the financial institution over there, right? After that, it's related to the segregation based upon according to ownership over there. So it could be related to owned capital. Like the owner or the promoters have contributed the funds themselves, like the share capital or equity share capital or the retained earnings over there or profits or surpluses, etc. Those are particularly as per the ownership, like those are the owned funds over there. And it could be the borrowed capital, like you have basically borrowed by means of loans, by means of debentures, bonds, commercial papers, etc. That's related to what? That's related to the ownership factor over there. And other than it's related to sources of finance. Now sources of finance, it could be the internal sources or it could be the external sources. Internal sources, when we have retained earnings, when we have plowed back the profits over there by depreciation funds over there, because depreciation is what? Depreciation is a non-cash expense. Nothing goes outside. It's particularly retained with you, so you can be using, that's a particular source of fund for you, right? And for the external sources, it could be related to that you have issued the shares, debentures, public deposit, or you have taken any loans, right? Those are the external sources. Okay, so it's quite important to learn all these all these segregations over there. And the other one, it's related to according to mode of financing. Now security financing or external financing. Now what do you mean by security financing? Financing means when you are having the corporate securities such as shares, debentures, and particularly you are issuing them so as to basically have the funds. That's actually related to security financing. Internal financing is related to what? That when you have retained profits, you are capitalizing the profits over there, you are particularly depreciation of funds over there. That's related to internal financing. You are financing basically internal sources are the internal financing sources over there. Or the loan financing over there, where basically you are raising the short-term loans or the long-term loans or the medium-term loans over there, right? Now let's have a look at the security financing. We are having the ownership securities or the capital stock over there, or we are having the creditorship securities or the debt capital over there. Now it's particularly related to what? It's related to equity capital, it's related to the equity capital, or it's related to the debt capital over there, right? Is that clear? Either it's the equity capital or it's the debt capital over there. Now let's have a look at the kinds of ownership of securities or shares over there. Now let me just explain to you with an example over there. Let's say case that in the case of MOA, that is the Memorandum of Association, it is mentioned that the company can maximum be taking a share call of 10,000 crore. Now that will be what? That will be the authorized capital. That will be the authorized capital. That is a maximum amount of capital which can be raised by the company over there. That's what? That's the authorized capital over there, right? Now out of this authorized capital of rupees 10,000 crores over there, the company decided to issue an amount of rupees 5,000 crores over there. Not related to 10,000 crore, but they said they will be issuing an IPO of amounting rupees 5,000 crore over there. Now what is 5,000 crore over there? This is actually the issued capital. I'm just writing it over here. This is the issued capital we are talking about, right? And after that, it's related to that the company basically had a prospectus with the SEBI, and further they asked for the applications from the subscribers over there. Now in the case of subscribers, there can be two cases. Either the subscribers can be having the applications an amount exceeding the issued capital. Issued capital amount is rupees 5,000 crores, and let's say the case the applications were more than the applications amount was more than the issued capital. Let's say case you received applications amounting rupees 7,000 crore. Okay, now in that particular scenario we'll be saying it's a case of over subscription. It's a case of over subscription over there, right? And the second scenario could be related to what? The second scenario could be that the applications received are lesser than 5,000 crore. Let's say case that you have received the application amounting rupees 4,600 crores over there. It would be the case of the under subscription. Under subscription it would be the case, right? Now in both the scenario that we know that the capital which is basically application you have received, that is what? That is a subscribed capital. That is what? That is a subscribed capital for the applications that you have received so far. Okay, that will be the subscribed capital. Now let's say case out of the subscribed capital, the amount that is actually paid by the subscribers over there, that is 3,000 crores. That is 3,000 crores. That is actually paid over there. Now that will be forming what? That will be forming your paid up capital. That will be the paid up capital over there, right? So you must have understood the different concepts related to the capital over there, right? So it's related to authorized capital, or it could be related to the issued share capital, or it could be related to subscribed share capital. Now called up share capital is that particular amount which is called from the subscribers. Like the share was amounting rupees 10 per share and you called for rupees 6. That's the first call, second call, etc. Right? That's what the amount that will be concluding. It will be the called up share capital, and the total amount that has been received so far, that will be forming the paid up share capital over there. I hope that you must have understood these concepts, right? Now let's talk about the equity shares. Now equity shares, as I told you, it's related to showing what? It's showing the ownership in the company over there. Now we are having a company XYZ, and further it's related to they issued the shares. They issued the shares over there and people invested into it and the company received the amount, and it will be forming what? It will be forming the paid up share capital. Paid up share capital, as I just explained to you. Okay. Now, when the amount has been received, it may be the case that the amount of the market share price of the share is rupees 13 and your face value of the share is at rupees 10 over there. It is at rupees 10 over there. Now, the amount difference of rupees 3, it's basically related to what? It's related to share premium account. It's related to the share premium account, right? Is that clear? Now, let me just tell you, now these shareholders are actual owner of the company. These are the real owner of the company over there, right? And this particular amount is available for a very long period over there. Till the time the company is not liquidity, the company is having no obligation so as to return back this particular amount over there. And also, when the company will be liquidated, this particular amount will be returned after particular setting off all the other expenses. When all the other expenses, all the other liabilities are set off, only after that, if some is basically left, then it will be paid to the shareholders over there, otherwise not, right? Now, when I told you that these persons are the owner, the shareholders are the real owners of the company. So if company will be making any of the profits, if the company will be making any of the profits, it's a obligation for the company so as to basically return these profits to the owners over there, and these particular profits are returned to the owners of the company, that is the shareholders of the company, by way of dividend. But it's not an obligation on the company so as to basically give back the dividend over there. It's not an obligation. The dividend may be paid, but dividend may also not be paid, and dividend will only be paid when there will be profit. Otherwise, dividend is not to be paid over there. Is that clear? Is that particular part clear over there, right? So now these particular equity shares are known as what? These are the ordinary shares or the common shares, which actually represent what? These represent the owner's capital in the company over here. And as I told you, these are the real owners of the company. These shareholders are the real owners of the company, and they can have the control on the company, and the majority of the shareholders will be having a control on the company. Let's say case that a shareholder is having 10% of the shares of the company over there, then he must be having a position in the company, either in the board of directors, either in the company board over there. They must be having a position over there, right? So equity shareholders, as I told you, are paid a dividend after paying to the preference shareholders. Now preference shareholders actually get a preference when the dividend is paid. Okay, only when the dividend to the preference shareholder is paid, and after that only the dividend is paid to the common shareholders over there. And the rate of dividend which is to be paid to the equity shareholder or the common shareholders over there, it is actually not fixed, and it depends upon all the profits over there. And it's not the case that the company made a profit of rupees 12 crore, the company will be paying a dividend of rupees 12 crore, will be distributing the dividend of rupees 12 crore. It's not the case. It may be the case that the company is retaining the profit for the future purposes, or the plowing back of the profits or something like that, right? Now let's have a characteristic of the equity shares over there. Let me just tell you that this is actually related to what? This is related to the permanent source to the company. Permanent source of the company, because these shares cannot be redeemed during the lifetime of the company. Only when the company will be liquidated, only then the amount will be paid back to the shareholders, common shareholders, after setting off all the other liabilities of the company over there, right? Is that clear? So it basically provide a cushion to the company so as to absorb the losses. So whatsoever the losses that will incur to the company, it will be acting as a cushion to the company over there, right? And further, the equity shareholders will be having the voting rights. They will be having the control over the working of the company over there, right? So these are the characteristics of the same. And board directors are elected. Like, what are the board of directors? These are basically acting as an agent of the company. Now let's say case that there are 2 lakh. Let's say the case there are 2 lakh equity shareholders. Now, definitely, they all are the owner of the company, but it's not possible, and that 2 lakh people will be taking a common decision. So, what happens in the annual general meeting of the company? The shareholders will be electing the board of directors. They will be electing the board of directors, who, on their behalf, will be handling the tasks over the company over there. So, they are acting as an agent of the company. They are acting as a agent of the shareholders over there, right? That's the case related to it. Now, limited company purpose is to increase the subscribed capital. Now, further, let's understand the concept related to the right issue. Related to the right issue over there. Let's say the case that there is a limited company XYZ, and they have basically issued the shares. They have issued the common shares or common equity shares over there, right? Now these shares are being issued, and further, these particular persons who have invested into this, these are now the real owner of the company. These are the real owner of the company. That part is particularly clear till now, right? And after that particular part, the company want to basically raise more capital. The company wants to raise more capital. Whensoever the company after the IPO wants to raise more capital, in that particular process, the company is to give a chance to the existing investors that if they want to increase their stake in the company over there, right? That's actually said to be the right issue. That's actually the right issue. Let's take the case that person A, B, C are the existing investors. In that particular scenario, they will be given a chance in accordance with the proportion of the shares that they are holding, that if they want to basically go for another set of shares, if they want to basically go for, but it will not be an obligation on them. It will not be an obligation on them. They can actually be going for another set of shares over there if they want to basically invest more. That will, the chance will be given, and that particular issue is said to be what? That is said to be right issue, because right is given to the existing shareholders over there. Now, when the right issue will be there, the person ABC are to pay. They are to pay, and new capital will be basically flowing to the company over there, right? So that's the case related to the right issue over there. And the right so given to them is basically the preemptive right over there. Preemptive right over there. But in what case the right issue is to be given? If the company wants to basically increase the subscribed capital by the allotment of further shares over there after the expiry of 2 years from the formation of the company, or the expiry of 1 year from the allotment of shares. Like let's take the case that the company XYZ issued the shares in 2023. In 2023, right? They basically issued the shares. Now, from 2 years from the date of issuance, 1 year from the date of issuance of previous allotment, 1 year from the date of the previous allotment, and the second scenario is related to formation of the company. Let's say this company was formed in 2021 over there. 2021 over there, right? And further, the 2 years will basically end in 2023. And in this particular between period, they want to basically increase their subscribed capital. For that particular purpose, they are only to issue the right issue. Otherwise, if this criteria is not met, let's say this company was formed in 2017 and the last issue was in 2020, and they want to basically issue a new issue right now, they are free to do so if these two criteria are not set. First criteria is related to that formation, 2 years from the date of formation of the company, and the second criteria is related to 1 year from the issue of the previous issue over there, right? If these two criteria are not met, in that particular case, right issue is not mandatory. Otherwise, if any of these criteria is met, in that particular case, the right issues are only to be issued, right, for the fresh subscribed capital. Okay. Now the preemptive act will doing what? The preemptive right will be doing what? Preemptive right will be protecting the equity shareholders by ensuring that they will be having only the control. They will be having the focused control over there. If the basically company wants to issue additional shares, it means the company is diluting their particular control in the company over there, and ultimately the new people who will be holding the shares, they'll also be having the control over the company over there. So basically the preemptive right protects the equity shareholders by ensuring that the control of the management will be in their hand only. They will be getting a chance for the same, right? And the shareholders liability is limited to the value of shares they are holding only. Let's say the case that the person A over here is holding rupees 10 lakh amount of shares, then the liability of person A is maximum of 2 rupees 10 lakh only, and not above that. His personal assets are not basically attached to it, right? That's the case related to it. For this related to, let's have a look at the advantages of the equity shares over here. Let's have a look at the advantages of the equity shares. So if we look at the advantages of the equity shares, first of all, it's related to that the company is having no obligation so as to pay a fixed rate of dividend. As I told you, there is no fixed rate of dividend in case of the common equity shares over there. And further, Equity shares can be issued without creating charge over the assets of the company. You need not to create any of the charge on the assets of the company when you're issuing the equity shares over there. And the third one, it's a permanent source of capital over there, except the case of liquidation over there. You need not to return the amount that has been invested by the owners over there, by the equity shareholders over there. And equity shareholders are the real owners of the company, and they are having the voting rights with them. And in case of profit, the dividend will be issued, and further, that's not actually related to that you have to pay the dividend at par of the profits over there, right? And if you look at the disadvantages of the same, if only the equity of the shares is issued, the company cannot be taking the advantage of the trading on equity. Now, let me just tell you something about the trading on equity over there. Trading on equity means what? It means that we are depending just upon the equity over there for the purposes of the business of the company over there, right? If you want to basically run the business, we are just depending on the equity over there. But there are other channels also, like we can also be going for the debt component over there. And further, we are using the debt component. In the next unit, we'll be learning about that we can be increasing the EPS, that is the earning per share, and ultimately we can basically grab attention of more and more investors over there, and we can make a goodwill over there. So the companies actually do use the optimum balance of the two. That's actually required. So if you're using only and only equity, definitely you are basically not taking the advantage on trading on equity over there, right? And further, it's related to, as equity capital, it cannot be redeemed. So there is particularly danger of capitalization over there. And moreover, the equity shareholders, they can put obstacles. Why? Because they are having the control over the company over there, right? And further, during the prospectus periods over there, higher dividends have to be paid, leading to the increase in the share value over there. And ultimately, that will lead to what? That will be lead to the speculation over there. Like in the prosperous period, when everything is going fine, and further you are basically having a very good profit, you are paying higher dividend to your shareholders over there. Ultimately, it will lead to what? It will lead to increase the value in the share price over there due to speculation. Let's say the case that a company is paying a dividend of rupees 20 first year, and then it paid dividend of rupees 25 per year. Okay, then more and more investors will be investing the money into it because they want to earn the dividend too. They want to earn the dividend. So ultimately, it's what? It's related to the more and more people will be basically demanding for the share of the company, and ultimately due to this demand and supply, the share prices will increase, and ultimately it will lead to speculation over there, right? And further, investors actually who they want to invest in safe securities over there with fixed income, they will not be having any attraction to the share equity holders over there, because what? Because the rate of dividend is not fixed in case of the equity shares, right? After that, it's related to the preference shares over there. Now, as I told you that if the company is there, company XYZ is there, and for the ABC are the shareholders over there, there is no guarantee that the dividend will be paid to them. But in the case of the preference shares, first of all, as the name suggests, they will be getting a preference. The shareholders will be getting a preference so as to receive the dividend over the common equity shareholders. So when the dividend will be paid, first the dividend will be paid to the preference shareholders. After that, the dividend will be paid to the common shareholders over there, right? That's the first scenario. And the other one, it's related to that the dividend rate is fixed in case of the preference shareholders. It will be fixed. And there are different type of preference shares over there, like we are having the cumulative preference shares. In case of cumulative preference shares, if the dividend is not particularly announced for one particular year, it will be aggregated, and further it will be added to the next year dividend over there, right? And it will be paid accordingly. Let's say case there are different years, 2018, 19, 20, 21, right? Dividend was paid for 2018 but not for 2019, not for 2020. In case 2021, the dividend will be paid for 19, 20 and 21 all along, right? In the case of the cumulative preference shares over there, right? And after that, it's related to the types of preference shares, right? In case of types of preference shares, like I told you, in the case of cumulative preference shares, they'll be right that they can claim the dividend for such years when there were no profits. In case of non-cumulative preference shares, there'll be no accumulation of the dividends for the years when the profit was not there and the dividend was not announced. And further, the third one is related to redeemable preference shares. Those shares are particularly redeemable, which can be redeemed over there. So company can be issuing the redeemable preference shares if the articles of association, that is AOA, are allowing to go for such an issue over there. And further, only and only such shares can be redeemed which are fully paid. So only such preference shares can be redeemed which are fully paid over there. And further, the company should be redeeming these particular redeemable preference shares out of the profits or out of the issue of the fresh capital over there, right? Only then these particular dividends, these particular redeemable preference shares can be redeemed. What do you mean by redeem? Like the preference share was issued, the preference share was issued to person A, and the person A fully paid the amount to company over there, right? Now person A basically want to return back this particular preference share over there. It is redeemable, right? In that case, the company will be paying the amount to person A and this particular preference share will be cancelled, right? And for the from where the amount will be paid, the company will either be paying the amount from the profits over there, or the company will be basically be getting the amount by the case of fresh issue, like they have issued more shares, they have issued basically right issue or new shares over there, and further they got a new capital. From that particular new capital, they can be paying for the redeemable share over there, right? After that, it's related to the irredeemable preference shares which cannot be redeemed, right? That's particularly related to irredeemable preference shares. And last one, it's related to participating preference shares. Now participating preference shares is related to what? That the company has made a profit. The company made a profit of 2500 crores and the company retained the profits of 500 crore, and further they issued dividend amounting rupees 1000 crore, and further still the amount of 1000 crore is left. Now if the persons are issued with the participating preference shares, now they can have an additional share in this particular profit that is retained after issuing the dividend to the different parties over there, right? That's the case related to participating preference shares. And non-participating preference shares means they do not carry any additional right of sharing of profits of the company over there. That's related to the non-participating preference shares. And further, it's related to convertible preference shares. Now convertible preference shares is related to when the preference share will be issued. In case of the convertible preference shares, whensoever the convertible preference shares are issued, those are issued with the timeline, that this particular share can be converted into equity. This particular share can be converted into equity after this particular time period. Let's say case they are saying that they can convert it into equity after 5 years, and further at what amount, in what ratio the shares, the bond instruments, the shares can be converted into equity over there, right? That's actually related to what? That's actually related to the preferences, convertible preference shares over there, right? That's the case related to it. And further, if there no such right is given related to conversion into equity shares over there, then it is non-convertible preference shares, right? Now let's have a look at the features of the preference shares. Now definitely the preference shares are basically preferred over the equity shares because there is a right related to it. You get a right so as to get a fixed rate of dividend, and further also you get preference over the common equity shares over there. And as I told you, the dividend rate is fixed, and further they are entitled to dividend if distributable profits are available over there. And also in case of cumulative preference shares, when there is no profit, the amount will be accumulated and further that will be paid when the dividends will be declared over there, right? And also the preference shares, the paid dividend out of the post-tax profits. So when the tax has already been calculated, after that the dividend is paid. So dividend which is actually paid on preference shares over there is a non-tax, is basically not a tax deductible expense over there. So whatsoever the dividend will be paid, let me just tell you on accounting purposes over there. Let's say the case the profit was rupees 10, and out of this particular profit the tax was deducted. Let's say the corporate tax is 50%. Okay, now as per the 50%, the amount will be rupees 5, and the left out amount, that is a profit after tax, it will be what? It will be 5 over there. It is rupees 5, that is a profit after tax over there. And out of this particular profit, the dividend will be paid to the preference shareholders over there. Let's say dividend of rupees 2 was paid. Okay, so that's particularly related to that it's a non-tax deductible expense because the tax has already been deducted. So it's a non-tax deductible expense over there, right? That's the case related to that I wanted to basically acknowledge. And further, the cumulative preference shares where the dividend is guaranteed over there, as I told you, right? And in case of redeemable preference shares over there, those are particularly as per the terms of the issue over there. Let me just tell you, those are as per the term of the issue over there. And as per the Companies Act 2013, companies which are limited by the shares over there, which are basically limited by the shares over there, those are prohibited, that they cannot be issuing. They are particularly prohibited from issuing the preference shares which are not redeemable. They can only be issuing the preference shares which are redeemable and none other than that, right? And preference shares are required to be redeemed with a period not exceeding 20 years over there. So this is the maximum period. So this is the maximum period when the issues can be redeemed over there and not later than that. And as per the Companies Act, the companies which are limited by shares, those cannot be issuing preference shares without redeemable over there, right? That's the case related to it. And preference shareholders have a limited right. They are having a limited right. But if the dividend is not paid, to the shareholders consecutively for the 2 years or more, in that case, the shareholders, the preference shareholders also will be getting the voting right related to the company's resolutions over there. That's actually required over there. Is that clear? So otherwise, the voting rights are what? The voting rights are limited. The voting rights over here are limited. But if the dividend is not paid for 2 or more years, in that particular case, they are getting the voting rights over there, right? After that, it's related to debentures. Now, what do you mean by debentures? What do you mean by debentures over there? Let me just tell you over here. That's the case company XYZ is over there. So debenture is a debt instrument. It's particularly a debt instrument over there, which actually acknowledges the debt that has been taken by the company over there, right? Let's say case a debenture of amount rupees 10,000 is issued. What is basically saying that the person A has particularly received a debenture. It means person A has given a debt amounting rupees 10,000 to the company over there, and the company is having an obligation. So as to return this particular debt amount and also to pay what? Also to pay the interest component to person A over there. It's not related to a capital, which is basically for a very long term period over there. As unlike in the case of the equity shares, the amount was not to be returned until in the case of the liquidation over there. But in case of debt instruments, the amount is to be returned. Let's say case the interest was 10%. Now in that particular scenario, an interest of rupees 1,000 will be paid to person A every year, and on the redemption and on the maturity date, a principal amount of rupees 10,000 will also be paid. So on that particular maturity, the principal amount is to be paid over there, right? That's the case related to debt instrument. That I hope that you must have understood the case. Now that's defined under section 2 subsection 30, and the debenture, stock, bonds or any other instrument which is basically evidencing a debt over there, those are the debt instruments over there. And it's a written instrument which basically acknowledges the debt over there that the company is promising so as to repay the amount back over there, right? And further it's related, let's have a look at the features over there. So it's a written agreement between the two, and further it could be also be a deed over there. And debenture is a particular instrument. Debenture is a particular instrument where the company is acknowledging, company is promising so as to pay that particular amount over there after some particular period of time. And further the companies have also having a liability so as to pay the interest component to the person who has basically given the debt over there, right? And it's particularly related to agreement over there. And if the debentures are issued to more than 500 persons, over there, in that particular case, it is required so as to basically appoint a trustee so as to look after the interest of the debenture holders over there. It's quite important point because this type of questions can be asked in the exams over there. So if the debentures are issued to more than 500 persons, trustees are required to be appointed so as to protect the interest of the debenture holders over there. And as per the section 71 of the Companies Act 2013, it basically creates a provision related to what? Related to the issuance of the debentures over there. Now, in what manner the debentures will be issued, what will be the procedure related to it, how this can be converted into equity over there, what are the voting rights associated with it, when it can be redeemed, creating reserves over there, prospectus or invitation, each and everything related to debentures are covered under the regulation under section 71 of the Companies Act 2013. Kindly please take a note, it is defined under section 71. Quite important to learn about it. All the regulations related to debentures are given over here, right? And after that, it's related to fixed tenure. The debentures can be of fixed tenure. They can be the perpetual debentures can also be issued. The perpetual debentures can also be issued, which are basically for indefinite time of period over there. The debentures are repaid on fixed date of the expiry of the term. If the debenture is having a fixed term of 5 years, the debenture is to be repaid after a term of 5 years. The principal is to be repaid back over there, right? And perpetual bonds are also permitted where the bonds are issued for indefinite time period over there, and only only the coupon is to be paid along, right? And further, there is fixed rate of interest that is to pay to the debenture holder over there. Like I told you in the previous example, that 10%, that the 10% of this particular dividend this particular interest percent, not the dividend percent, the interest percentage of 10 is to be paid to the debenture holder over there. So that's related to fixed percentage. But these debentures can also be issued on discount. Like in the case of the zero interest or zero coupon bonds over there, what actually happens, there is no coupon amount which is paid. Let's say case debenture was issued, is having a face value, it is having a face value of rupees 10,000, it is having a face value of rupees 10,000, but it is issued on a discount. It will be issued on a discount. The debenture holder will be, or the bond holder will be getting this particular bond for rupees 9,000, and on the maturity the person will be getting the face value of rupees 10,000 over there. Now there is an intrinsic yield in that particular case of rupees 1,000, right? Is that clear? Okay, so that's the case of the zero coupon bond over there. After that, it's related to options with the issuer. Whensoever the option with the issuer we are talking about, option with the issuer over there, we are talking about what? We are talking about the call option over there. We are talking about what option? We are talking about the call option over there. Now, call option basically gives a right to what? It gives a right to buy. It gives a right to buy. So it's basically giving a right to the issuer over there that they can buy back the debentures they have issued. That's actually related to call option. So whenever we're talking about the options with the issuer, the company issuing the debentures can incorporate an option like a call option over there, where they will be paying the repay the principal amount before the due date over there and can buy back the debt instrument over there, right? That's the case related to put option. And also there is option which is lying with the seller, which is basically lying with the buyer over there, not with the seller, with the buyer over there, where the buyer is having a right, which is said to be the put option over there. Now put option gives a right to sell, where the buyer can actually be selling the instrument before the maturity date. They need not to wait for the maturity date, and further they can be selling the instrument before the maturity date over there. That's related to the put option over there, right? And further, the debenture holders do not get any kind of the voting rights related to it, and that's covered under the section 71 over there. And further, if we talk about the stake over there, in that particular case, the convertible, that is wholly or partly convertible debentures which are permitted to be issued, they get actually the equity stake in the company over there. So let's talk about the convertible debentures over there. It's related to the convertible debentures. Now what do you mean by convertible debentures? Where after a particular time period, this particular debt instrument or the debentures over there can be converted into equity over there. They can be converted into equity. Now what will be the benefit of the company? Now when the debentures were issued, the company was having what? The company was having the obligation. What obligation? So as to pay back the principal amount, so as to pay back the interest amount over there, and that's also on the maturity date. There was an obligation. But if the debenture holder executed this particular option and converted the debentures into equity over there, now in case of equity, as you have learned, there is no obligation on the company so as to return the amount. So that's an advantage to the company. So that's an advantage to the company, that the company need not to repay the amount back over there. That's an advantage to the company over there. Now what's the advantage to the debenture holder over there? Let's say case the debenture was amounting rupees 10,000. And it was decided that based upon this particular debenture, when the debenture holder will be converting this debenture into equity over there, he will be getting the 100 shares. He will be getting 100 shares of equity over there for one particular debenture over there. Now, let's say the market price of one equity share was 112 rupees. It was 112 rupees. So definitely the debenture holder is going to execute this particular option over there. Why? Because when he will be executing, the market value of this particular debenture will be amounting 11,200 over there, which is higher than the debenture original amount, right? So there will be a capital gain to the debenture holder also, right? And also the company will be benefited. So that's the case related to convertibility over there. And if they're converting into debentures to the equity over there, definitely they will be getting the right. They will be getting the voting right over there, right? Further, it's related to types of debenture. So these can be based upon tenure. These can be based upon tenor, so there can be a fixed tenor, or it could be limited by a call option or put option over there. Okay, and based upon security, it may be the case that debentures which have been issued to the debt holders or debenture holders over there, those are actually issued based upon the particular asset of the company over there, because it may be the case that there are secured debentures, it may be the case that they are unsecured debentures over there. It may be the case the first charge on the asset of the company is created, or the second charge on the asset of the company is created over there, and further it could be based upon convertibility, that these debentures can be converted into partly or equity. Convertible debentures can be there which can be converted into equity over there, and further it could be related to negotiability. In most of the cases the debentures are transferable by way of a registered transferred form over there, but it may also be the case of the bearer debentures, where by delivery over there you can actually be transferring the debenture from one person to another, right? Now let's understand the advantages of the same. So when the company is issuing the debt instruments over there, definitely in that particular scenario the control of the company still remains with the equity shareholders only, and not with the debt holders, right? Not with the debenture holders over there. So that's the first benefit. And further, as I told you, that debentures actually do provide a fixed, regular and stable income to the investors over there. The investors, the debenture holders, will be getting a fixed income over there, and comparatively these are safer. Why safer? Because in these particular cases a specific charge, floating charge or second charge is created on the asset of the company over there, right? And further, investors do prefer debentures because they are having a definite maturity period. That's not the case with the equity shares holding over there, because there was no definite period related to it. And also the debenture holders are protected by various provisions under the debenture deed. As I told you, debenture deed is necessary, and the trustee is to be appointed if the debenture is issued to more than 500 persons over there. So those are protected over there. The interest of debenture holders is protected, and also the interest on debentures is a tax deductible expense over there. Unlike in the case of the preference shares, I told you it's a basically not tax deductible expense. But in case of the debentures, let's say your total profit was rupees 10, right? That is a total profit, and you basically paid an interest of rupees amount 8 to the debenture holders over there. Now this will be deducted before calculating the tax over there. So your taxable income will be rupees 2 over here. Is that clear? So that is what the company is to pay lesser tax amount over here. Is that right? And after that, it's related to company can trade on equity by mixing the debenture in its capital, and it can be increasing their EPS. As I told you, if the company is basically trading just on based on equity over there, that basically its capital composition is based by equity only. In that particular case, the EPS will be lower. But if the company is basically utilizing the equity as well as the debt instruments over there, in that particular case, there will be higher EPS. In that particular scenario, right? Now let's have a look at the disadvantages. Definitely there is a legal obligation on the company so as to pay back the amount, otherwise the legal obligations will be there. And further, a fixed charge is created on the asset, and the assets on which the charge is created, the company is restricted so as to create a further charge over there. And further, the company cannot raise further loans over there because the security of assets is already created over there as already mortgaged to the debenture holders over there. And further, the debenture holders do not carry any of the voting rights, so the debenture holders are not having any of the controlling powers related to the management of the company over there. So that's a disadvantage. And also they do not have any claim on the surplus assets or profits over there. Like I told you that the person A is a debenture holder amounting rupees 10,000. In that particular case, if the company is liquidated, that person A will be getting maximum up to rupees 10,000 only. Not the person A is basically not concerned about the profits which the company is making from the rupees 10,000. He has basically debited to company over there, right? Is that clear? And after that, let's understand the difference between the shares and debentures. If we talk about the meaning of the shares, these are the owned funds. These are the company owned funds over there, whereas the debenture is representing the debt funds over there or the borrowed funds over there. And for the equity is the capital of the company, and the debentures are the debt of the company, and the holder is shareholder and debenture holder in that particular case, and the status of holder, these are particularly owners, these are the creditors to the companies over there. And if we look for the form of return, it will be in the form of dividend, and in this case it will be in the form of the interest over there. And if we look for the payment of return over there, if we look for the payment of return over there, it is only the dividend is paid only out of the profits over there, but the interest is to be paid even if there is no profit. Even if there is no profit, the interest is to be paid to the debenture holders over there. And if we look for the allowable deductions over there, dividend is an appropriation of what? Is an appropriation of profit over there. It is basically appropriation of profit over there, and further it is not basically tax deductible. It is not tax deductible, whereas in the case of the debenture, the interest is tax deductible over there, right? And further, if you look for the security for payment, there is no security for payment, because if there is no profit, no dividend is paid. But there is security for payment, because it may be the case that secondary charge is created on the assets of the company over there. There is no voting right in case of the debenture, where there are voting rights in case of the shares over there. And if you look for the conversion is not allowed, whereas the conversion to the equity shareholders can be allowed in case of debentures over there. And if you look for the repayment in the event of winding up of the company, shares are repaid when the company has repaid all of their liabilities. Only after that the repayment is possible over there. But in case of debentures, they get priority before the shares. They get priority before the shares, and further they will be repaid before the shareholders are paid over there. And if we look for the quantum, it is actually related to appropriation of profit, and whereas there is a charge against the profit over there, right? And for the trust deed is not necessary in case of shares, whereas the trust deed is actually necessary where particularly the debentures are being issued over there, right? After that, it's related to the internal accruals. Now, internal accrual is actually related to what? It's related to that let's say case that the company made a profit of rupees 10 crore and we retained 2 crores out of it in the form of general reserves. That's actually related to the internal accrual over there. And it may also be the case that depreciation, which is a non-cash expense, which is a non-cash expense, that is actually retained for your other expenses over there. And it will also be the case that the non-cash profits charged to the profit and loss account in the form of provision and reserves over there. Like you created a free reserve or other disclosed reserve, and further you charged it to the profit and loss account over there. You appropriated it to the free reserves over there. That's also related to internal accrual over there, right? And further, it's related to internal accruals are basically what? These are the plowed back profits. These are the plowed back profits, because the profits which the company has generated, let's say case the company generated a profit of rupees 10 crore. Now this profit is actually belonging to what? This profit belongs to the equity shareholders. It belongs to the equity shareholders. It must be appropriated to the shareholders in the form of the dividend. But the company is also to manage the different concerns related to operations of the company over there. Definitely the company needs to basically retain some of these profits over there. This is actually related to internal accruals over there. And further, if these are basically belong to basically equity shareholders over there and become equity if these are converted into the bonus shares with the regulations over there. Now this particular profits which are plowed back over there, these can be issued in the form of the bonus shares, and ultimately it can form as per the part of the equity over there. Now let me just tell you about the bonus shares. Now let's say the case that you are shareholder owner, person A, B, C are shareholder owners. Person A is having 50 shares, person B is having 100 shares, and person C is having 200 shares, right? And the company plowed back the profits, right? And the company decided so as to issue the bonus shares. It basically decided to issue the bonus shares in proportion of 10:1. It means if the person is holding 10 shares, then the person will be awarded with 1 bonus share. Okay, bonus means no new capital will be infused, no new capital. So person ABC, who are the investors of the company, they need not to pay any of the amounts, right? So person A over here will be getting how much bonus shares? Person A will be getting 5 bonus shares, person B will be getting 10 bonus shares, and person C will be getting 20 bonus shares over there. So this is actually related to what? This is related to capitalization of the profits. This is related to the capitalization of the profits, where you are converting your profits into capital over there, into your equity over there. That's the funda related to it. I hope that you must have understood the component related to it. Now let's have a look at the advantages of the same. Definitely there is no restriction related to the use of the internal accruals. You just cannot be using it for what? You cannot be using it for the purpose of Like in the case of the depreciation, depreciation is what? Depreciation is a non-cash expense. Depreciation is non-cash expense over there. And further, if it is basically a surplus that you're having. It is particularly a surplus that you are having over there, and it does not affect the general reserves over there. And this particular amount cannot be used for issuing the bonus shares. You cannot issue the bonus shares amount, bonus share out of the depreciation amount over there. And further, you cannot be used the depreciation amount for declaring the dividend over there, right? So this is the exception. Otherwise, there is no restriction related to use of the internal accruals over there. And after that, it's related to, it can be used for the long-term purposes as for the short-term purposes over there. Like if you want to use it for the day-to-day working capital purposes, you can go for that. If you want to use it for the long-term fixed assets, you can go for that. And these funds are readily available. There is no cost that you have to pay for these funds over there. And internal accruals are liquid and readily available over there. And this does not change any type of the ownership structure of the company over there. And it does not result in the dilution of the control over there, and there is no cost of raising these funds over there. So these are the advantages of the same, and disadvantages related to indiscriminate application of the retained earnings over there. Like I told you, these amount belonging to what? These amounts are belonging to the shareholders over there. Now if the amount of rupees 10 crore is not appropriated properly, definitely, and it is used basically not in a good way, in that particular case the shareholders interest is not taken care of, and they may feel aggravated about it, right? And retained earnings are deprivation of dividend over there, because that amount was to be issued to the shareholders over there, but you are depriving the shareholders so as to get that particular amount as dividend over there, right? So it can basically hurt the shareholders, particularly the minority shareholders over there. And further, the company cannot build a good dividend track record if they're basically retaining the profits again and again and not issuing the shares over there. That's the case related to it, right? You must be understanding the component related to it. And further, it's related to safety cover provided by the retained earnings is reduced by the use of it. Now if you have retained the profits over there, definitely it's a safety cover for you. You can basically be using it for absorbing the losses over there. But if you have used it somewhere, definitely the safety cover is reduced, right? Now after that, it's related to retained earnings or plowing back of the profits over there. So plowing back of the profits basically means what? That all the profits are not distributed among the shareholders, and some of the profits are particularly retained so as for reinvestment into the company over there. And what is the necessity of plowing back? Because you want, it may be the case that you want to replace the old asset. It may be the case that you want to use the funds for the expansion of the company, for contributing towards the fixed as well as the working capital needs of the company. It may be the case that you want to increase the efficiency of the company related to plant and equipment over there. It may be the case that you want to make the company self-dependent of the financing from the outside sources over there. It may be the case you may require the funds for these particular scenarios over there. Okay, so that's the case related to it. You may be requiring the funds for this particular purpose, right? After that, it's related to term financing by the commercial banks. Now what do you mean by term financing? Term financing means when we do require the funds for the long term period over there, and we do require huge funds for the same. Now for that particular purpose, the banks are actually sanctioning loans for the same. Now let's have a look at the features of the term loans over there. Now let me just tell you that the period of, if we look at the period of the loan, the term loans are basically sanctioned for the short term period. If those having period lesser than 12 months over there, those are basically sanctioned for a medium term loan over there. The period is ranging from 1 to 5 years over here, and this short term period is up to 1 year, and medium term is from 1 to 5 years. And if it is basically from a period ranging from 5 to 10 years, in that particular case, it is what? It is long-term loan over there. And what is the purpose? It could be the case that you want to basically go forward. You basically want to acquire a new fixed asset. You can basically go for that. And it will be the case that you want to basically go for a short-term term loan. That is in the case of the working capital term loan, WCTL, you can go for. That's basically for day-to-day expenses over there. And the interest rate, basically that is predetermined rate, or it may be a fixed rate also. It may be a floating rate also, depend on the many of the factors related to the reputation of the company, related to the rating of the borrowers over there, related to credit worthiness, as well as all the other things over there. It basically depends upon the same, and interest rate will be varying on depending on all the factors over there. And if you look for the repayment is actually related to when you are going to repay the different amount over there. So it will be related to a moratorium period is allowed. The moratorium period is basically is related to what? It is related to repayment holiday. The moratorium period is said to be what? It is a repayment holiday. What do you mean by repayment holiday? When you need not to pay the principal amount, only the interest component is to be paid. That is actually the repayment holiday over there in case of the companies over there. And depending on the project tenor, and the type of the project and the type of the loan over there, this moratorium period can be varying. Okay, so that's the case related to it. And further, amount of loan. Now in case of purchase of existing assets, the lender will be basically carrying out the independent valuation, and they will be going for what margin will be given by the borrower over there. Let's say case an asset of amount rupees 10 crore is to be financed. Now the bank will not be financing rupees 10 crore. Let's say case the bank financed rupees 6 crore and asked for 40% of the margin. That is 40%, that is 4 crore rupees will be contributed by the borrower over there, and 6 crore amount will be basically sanctioned by the bank over there, right? So as to purchase the asset over there. And further, it's related to WCTL. WCTL is basically what? This is working capital term loan. So it is a term loan against the current asset. It's a term loan against the current assets over there, because it may be the case that there is a liquidity fluctuation or a liquidity problem over there, and bank may do provide a CC limit also, but bank may also provide a term loan for the same, right? And in that case, the installments will be fixed. The companies to pay the installments over there, and accordingly it will be going with, right? And after that, it's related to conversion. Now conversion is not usual, but it may be the case that this is common agreement between the borrower and the lender over there, that the loan is to be converted into the equity shares over there at a later stage, right? And that's the case related. Further, it's related to private equity. Now private equity basically related to organization as partnership, and basically they are specializing in the venture capital over there, related to the leverage buyouts, related to mezzanine investments or build-ups, distressed debt, or other related investments over there. And particularly this investment is for the longer term period. Let's say case there is a company XYZ, and they do require funds for a long term period. Over there. Now they can go for issuing the bonds, they can go for issuing the debentures, or they can take a term loan from the banks over there, term finance, or they can doing what? The private equity. They can go for the private equity. Now in case of private equity, these are basically specialized organizations. Let's say case ABC company is there, which is basically private equity joint venture company investments over there. And further, this company now will be investing the funds into XYZ for a longer term duration over there. That's related to what? That's related to private equity over there. Now the funds could be required for different types over there, like it could be a seed financing. Now seed financing is related to what? Where small sums of capital is required so as to develop the business idea, right? Now when the business is just a seed, nothing is there, just an idea is there, and we basically want to do what? We want to develop that particular idea. Amount of capital is required, that is particularly funded by way of seed financing over there. The second one is related to startup financing, like for the product development purposes, for the initial marketing activities purposes, you do require funds. That's the startup financing over there. For first stage, it's related to what? It's related to when you basically want to commence the commercialization, and for the product development purposes, production purposes, that's the first stage. Second stage, it's related to providing working capital funds, and for the time-bound growth over there. That's the second stage. Third stage is related to proper growth and expansion of the companies over there. That's actually required over there, right? And what is bridge financing? When this particular company, let's say XYZ, wants to basically go for an IPO. For that particular purpose, they do need funds, but they do not have any funds. Now this bridge of going from the company, a private limited company, to the public limited company, the funds will be basically brought by way of bridge financing over there. And what are the pipe deals? A private investment in private equity is basically said to be what? It is said to be pipe deal over there. It's related to selling of publicly traded common shares. That you want to sell the publicly traded common shares or preferred stock or convertible security to the private investors over there. So you'll be selling these all things related to the publicly dealing stocks over there, shares over there, convertible debentures over there, preferred stock over there, to the private players. That's the pipe deal over there. Right? After that, it's related to FDI. That is a foreign direct investment. Now the foreign direct investment can be by way of two ways. One, it's related to automatic route, where there is no government approval or RBI approval is required. And for the second one, it's related to government route, where the requirement is where the prior approval from the government of India is to be taken. You basically need to take a prior approval from the government of India, Ministry of Finance, Foreign Investment Promotion Board over there. You do require these approvals, only then basically you can go for the investment over there. It's related to government route over there, right? So Indian companies can freely issue the shares convertible debentures or particularly preference shares subject to the valuation prescribed by the FEMA regulations over there. Now FEMA is what? FEMA is what? Foreign, basically what? It is Foreign Exchange Management Act. It is Foreign Exchange Management Act over there. Now as per that particular, whatsoever the regulations are there, you need to follow that, and further you can be issuing the same, right? Whatsoever the instrument you want to issue. And for the issue of other type of preference shares such as non-convertible or optionally convertible or partially convertible, these are considered as debt over there. These are considered as debt. So when you are issuing the equity shares or convertible debentures or preference shares, that is all right. You're basically going to issue all these systems as per the FEMA regulations. But if you're going to issue the non-convertible, optionally convertible or partly convertible, in that case, it will be considered as the debt component over there. And as per the guidelines, you can also go for ECBs. ECB is what? It is external commercial borrowing. Now an amount up to 750 million USD. 750 million USD, that is allowed maximum by way of ECB. This particular maximum amount is allowed by ECB over there. And further, you can be actually be borrowing the amount from the eligible borrowers over there, recognized lenders over there. They can be using this particular channel also, right? Further, it's related to foreign investors can be investing in Indian company, which is basically a small scale industrial unit over there, which is not basically engaged into activities which are prohibited under the FDA policy over there. Such investments are capped to 24% of the paid up capital of the Indian company or SSI unit over there, right? So it's an important point to note down. So foreign investor can invest into Indian company, which is a small scale industry, which is not engaged in the activity of agriculture or horticulture or real estate business over there as per the FDA policy. Such investments are subjected to maximum 24% of the paid up capital. 24% of the paid up capital of that particular unit over there, right? If the unit is SSI unit, in that case, this regulation is to be taken care of, right? To SPAC, that is a special purpose acquisition companies. So SPAC, or particularly a blank check company, is actually formed to raise money through the IPO so as to buy another company. So here it is the thing. Let's say case that you want to acquire some company or you want to get into other company to merge into your companies over there. In that scenario, you will be launching a SPAC, and further you'll be putting it to the IPO, that is the initial public offering. People will be investing into your company. Now this particular money that is raised to IPO will be used so as to acquire, so as to buy other company, that is actually SPAC. So SPAC do not have their business of their own, so particularly they are there for the acquisition purpose only. And further, shares are structured as trust over there, and they can be having a face value of USD $10 per share or more, even that. Okay, and moreover, SPAC will be having 2 years with them so as to complete the acquisition part, right? Once they have particularly launched the IPO, after that they will be having 2 years so as to find the target, and further they are to basically get the affirmation from the shareholders, and after that they are going to acquire the target. And particularly if they fail to get the acquisition done, or if they fail to basically find any appropriate target over there, in that scenario, whatsoever the money they have raised and whatsoever the profits they have earned so far, those are to be distributed among the shareholders again, and it will be liquidated, right? But the Indian regulatory framework, let me tell you, it never allows for the creation of the blank check companies in India. And the Companies Act 2013, it stipulates that the registrar of companies, that is ROC, can strike off the registration of company if the company does not commence its operations within 1 year of its incorporation. So okay, so it means if a company has been incorporated but it has not commenced its operation, in that scenario the ROC can be striking out that particular registration, right? That's the main thing related to it. And further, after that, it's related to the money that are collected by SPAC, that is to be placed where? That is to be placed in a trust account. Okay, let me showcase you this one. Let's take the case. Here we are having a company that is a SPAC, that is a special purpose acquisition vehicle, that is created. Now they basically launched the IPO, people invested heavily into it, and ultimately they got the funds. But now they will be placing these funds in some trust fund who will be handling the funds over here, so that the interest of the shareholders is particularly reserved over there. And further, these funds can only be used for the acquisition of the company, and in the event, in the worst scenario, when the SPAC is dissolved, in that scenario, the money will be returned to the investors or the shareholders, right? Now, let's just like few of the instances. Now, the interest that is accrued from the trust account may be applied toward the aim of providing SPAC with the working capital, because if the trust is particularly there where the money is kept, now let's say the working capital is also required as a routine expenses are to be made, day-to-day expenses are to be made. So that money will be coming from where? That money will be coming from the trust itself, right? Now, after an acquisition has been completed, SPAC will typically apply to be listed on one of the stock exchanges over there, right? So once you are particularly, you can say once you have completed the acquisition, in that scenario, the special purpose acquisition vehicle will be applying so as to be listed on some recognized stock exchanges. Now let's have a look at the advantages of the same. First of all, it's related to speedier acquisition. Now in previous scenario, I've basically told you that SPAC merger typically happens between 3 to 6 months, but in case of the IPO, it generally takes from 12 to 18 months to complete over there. So it's a speedier acquisition related to merger of the SPAC into something, and further discovery of the price upfront over there. Now the price of IPO will be determined by the market. Now particularly when the SPAC will be raising the money at the time of its listing, the price of the share will be speculated, it will be determined, but the company that the particular SPAC over there is going to negotiate with the target company after the finalization of the same, right? So it's basically far more favorable strategy in the unstable market out there, and particularly the possibility of raising additional capital. Now SPAC sponsors can raise additional capital also through the PIPE. That PIPE is particularly what? It is private investment in public equity, right? So they can be raising more debt. Let's say case that SPAC raised 8,000 crores. Okay, just for the instance we are considering that SPAC raised 8,000 crore for the acquisition, but they need extra funds over here. So for that particular purpose, they can raise debt. Either they can raise a debt, or particularly they can go for PIPE, that is private investment in the public equity. They can go for these things also, right? And after that, it's related to reduced marketing cost. Now decreased costs are associated with the marketing or the SPAC over there, SPAC merger over there, because the market is actually not required so as to attract the interest from the investors out there. So reduced marketing costs are there, and ultimately ease of access to specialized operational knowledge. Now when investors, mostly the investors who are going to invest in SPAC, those are actually the seasoned businesses and those are the financial experts, so they can be providing their managerial expertise to the SPAC company over there, and also they can be acting as the board of directors for the SPAC too, right? That's the main thing related to advantages. And for the what are the additional advantages related to it, let's have a look at it. First of all, both the valuations and finances will be raised as well. What do you mean by that? Let's say the case that there is a particular IPO of SPAC. In that scenario, you're not basically clear about that in what particular company, what is a target company for this particular SPAC out there. So people are just particularly putting the money into it, and further they're just simply having the agenda that this particular SPAC will be acquiring some company so as to raise the value, and ultimately this will be giving a hype to the IPO, and ultimately when they acquire the company, it will be giving the overall valuation hike too, right? So these are actually advantages. Okay, and further it grants a greater degree of control over the stipulations of the transactions over there. And further, like I told you that the SPAC do not have any other operations of their own, so they do not have any other they are actually having lesser regulatory oversight, right? And further, when we are comparing IPO, when we are comparing it to an IPO, the process of going public with a high leverage company is made much simpler by the availability of SPAC. Now what do you mean by a leverage company? Where the part of debt is mostly used as to buy out a company. That's a leverage buyout, right? Now particularly in this scenario, what is happening, that we are raising the money by way of debt from the people out there, and particularly we are using the leverage. We can also be taking the PIPE or the public debt out there, and ultimately we're going to invest in companies so as to basically buy that particular company. So we can make use of the leverage in the same manner, but very easily using the SPAC procedure. Further, let's have a look at the disadvantages of the SPAC. First of all, it's related to inability to track use. Now definitely when you're going to invest in SPAC IPO, you're not having no idea where the fund will be invested, right? That's the first poor concern. And the other, it's related to poor returns, because the money which is going to be invested in SPAC, they do not get you that much returns involved in it, and ultimately what will happen that the initial particular hype, when it goes off, you're not having that much hype in the valuations, also hype in the share of the prices, also you're getting poor returns over the same. And third one, it's related to low market cap. As I told you, that it may be the case that there is an initial hype related to SPAC over there, but ultimately it's going to, that bubble is going to burst out, and ultimately what will happen, you'll be having a lower market cap, that lower trading volume in the market out there, for the increasing regulatory oversight. Now previously I told you that the regulatory oversights are lesser in that particular scenario, but SPACs have particularly lost their dieselness because there is increased regulatory actions which have been taken, and further it is actually very much difficult so as to work around such many particular regulations over there, right? And for the increased disclosure norms, now you have to declare and particularly disclose each and everything, that what are you going to do, what are your transparency, and how this money is going to be used, and everything related to it. Now new accounting regulation which has been issued by the SEC, that is the Securities and Exchange Commission, in 2021 over there. Now definitely after that, people are not filing that much things for the newer SPACs out there, right? Previously there were very much filings related to same, but now people are not basically concerned about, because there is very much increased disclosure norms, there is very much higher regulation degrees out there, right? That's the main concern. And further, the sixth one, it's related to shareholding dilution. Now SPAC sponsors, particularly if we talk about the SPAC sponsors, they are holding 20% particular shares in the SPAC. If we talk about 100% shares in the SPAC, 20% of the shares of the SPAC are particularly held by their sponsors. Okay, so that's a quite scenario. And further those are particularly taken, and further other than that, they are also having the warrants with them. They are also having the warrants with them, by which they can be purchasing the additional shares too, right? Now the SPAC sponsors ultimately are having this particular share in the SPAC out there, particularly they can also be diluting their shares into it. That is another disadvantage related to it. And for the deficiency in available capital, now initial SPAC investors may choose to redeem their shares. It may be the case that previously, that let's say case when we started a SPAC, in the case initial investors have poured their money into SPAC out there because they want to register the company and the other expenses are to be done. Ultimately they have invested the money which will be taken as a debt by the SPAC over there, and ultimately when the SPAC was formed and the IPO was issued and further the funds were generated, it may be the case that the initial investors or promoters may redeem their shares. Okay, so that will lead to what? That will lead to deficiency of the available capital out there. Okay, let's say case that they have marked that they have spent 20 crore in initializing the overall operations of the SPAC out there, and particularly when the SPAC was all formed, they redeemed 20 crore amount of their shares. Ultimately it will lead to what? It will lead to lower capital with you, right? And further it's lead to compact time frame for compliances, because I told you there is now very high degree of compliances. There is a very high degree related to transparency you have to make. So you have to do the SEC filing, that is a Securities and Exchange Commission filings also, those are to be done, and other regulations are also to be followed. So there is a very shorter time frame rather than in that is actually present in case of SPAC as we compare it with the IPO over there. Further it's leading to narrow scope for financial diligence. Now SPAC process actually does not require any stringent due diligence. Okay, if we compare it to the IPO, the stringent due diligence is not required in case of SPAC, right? And further it may lead to what? That when you are having not stringent regulations, those are to be followed, or due diligences which are to be followed, definitely it may be the case that you are basically leading toward potential issues or potential incorrections out there. It may be the case that you are having an incorrect business value or something like that, and it may also be causing more lawsuits over there. So these issues may arise in that scenario. And further it's leading to absence of underwriting and comfort letter, because I told you that because target company in SPAC is already public, because the target company in a SPAC which you're going to acquire over there is already public out there, it does not have an underwriter. So in that scenario, the SPAC is not going to having an underwriter which will be underwriting the shares, that which will be processing the book building process or something like that, or which will be doing something like that if the issues are not particularly not subscribed over there. In that scenario they will be underwriting the books over there. So those things are not present, and ultimately it's also be considered as a disadvantage. So what are the major disadvantages? First of all, it's related to inability to track the usage, poor returns, lower market cap is there, regulatory concerns are more, disclosure norms are more, and further shareholders can dilute their shares, and there is deficiency in available capital out there. There is compact time frame related to compliances, there is narrow scope for the financial diligence out there, and there is absence of underwriting and the comfort letter in case of SPAC, right? Now let's consider the SPAC formation and the timelines related to it. Now after the IPO, let's say case there is a SPAC which is formed, that is a special purpose acquisition company is formed, and further they issued the IPO, that is the initial public offering, right? They issued the IPO out there, and further for that particular purpose, whatsoever the proceeds of the IPO, those are to be kept where? Those are to be kept in a trust account. Those are to be kept in a trust account there. And SPAC will normally be having 18 to 24 months. They'll be having 18 to 24 months so as to find and finalize the target, right? They basically need to find a company which they want to purchase, right? They basically need to find that particular firm over there. This is called what? This is called a de-SPACing, that they need to finalize the target and they further are to complete the merger with it. They need to complete the merger with it. That is particularly said to be the de-SPACing process. That is the de-SPACing process. And further, if they're not able to accomplish a merger, if they are not able to accomplish the merger, in that scenario, the SPAC which was formed, it is to be liquidated. This particular SPAC will be liquidated, and whatsoever money that was there in the trust account, that will be actually be distributed among the shareholders. That will be distributed among the shareholders. That is the process, right? And further, the public shareholders of the SPAC have the option to vote against the deal. Let's say case that SPAC is there. Let's take the scenario that SPAC is there and they're having 18 to 24 months for de-SPACing purposes, and in the meantime they found a target company, but the public shareholders who have basically invested into the SPAC over there, they can be basically going against this particular target. They can be basically voting against the same, that we do not want the merger with this particular target company, right? This may happen, right? And further, once the announcement related to merger has been made, after that this negative voice can be raised by the public shareholders, and further it may be the case they can also be choosing so as to redeem their shares. Okay, and further, if SPAC needs additional finances, let's say case they have redeemed their shares, the person who were negative, who were basically not affirming this particular target, they basically redeemed their shares, and after that particular scenario, it may be the case that SPAC requires extra funds, so those can be raised by way of debt, or those can be raised by way of PIPE, that is public investment, private investment in public equity, right? That can be done through the same, right? And alternatively, SPAC may sell additional assets if it's the case that they're having redundant assets with them, which they may sell so as to basically raise much more funds, right? And further, it's related to SPAC merger. Now let's have a look at it. It's related to the SPAC merger. Now SPAC will be required to seek the permissions of the shareholders. Let's say case they found the target company, now they basically seek the confirmation. They do require the confirmation from the shareholders in which they want to be merged, and further it will also prepare and file a proxy statement. Now SPAC will be doing what? They'll be filing a proxy statement or a joint registration or proxy statement if it intends to basically register the securities as part of the merger out there. So they will be filing this particular proxy statement over there, and this particular document will be containing a description of the proposed merger, that whatsoever is proposed, what are the different aspects related to this governance out there, that merged entity related to it. So those all will be explained in this particular document, and further it will also be including the financial information related to the company in which they are going to target for the merger over there, right? And those all will be covered, and financial statements will be covered, and further management will be discussing the overall analysis related to merger and acquisition, and further the merger will be finalized. Once let's say case they have obtained the confirmation from the shareholders, after that the merger will be finalized with the target business in the transaction, and further it will be causing what? That the SPAC was actually a special purpose acquisition company. Now it is now merged into some public entity or public company, and ultimately it will go public. Ultimately this company, the merged company, will go public itself, right? So the merger will be finalized, target business will be transitioned, and further it will be leading to what? That it's a public company now. SPAC is now a public company, and within 4 days of closing, that after the merging, it's related to form 8K or super 8K form must be filed with the USEC, that is a United States Securities and Exchange Commission. Okay, so it is particularly to be filed within 4 business days of closing, after particularly they have done the regulatory compliances, after they have particularly considered and further finalized the transaction out there. Ultimately after that, within 4 days, particular filing in the form 8K or super 8K form is to be done with the USEC, right? Further, it's related to stakeholders. Now, the stakeholders in SPAC, we are having three different kind of stakeholder groups over there. We are having the sponsors, we are having the sponsors, and other than that we are having the investors who are going to invest, and thirdly we are going to have the targets, right? So firstly we are going to talk about the sponsors. Now sponsors are those who will be creating the SPAC, right? Actually SPAC is started by the sponsors itself, so their contribution is actually related to that they will actually be putting money which will be non-refundable fees. Let's say for formation of SPAC, whatsoever fees were paid, whatsoever attorneys they have hired or accountants they have hired, or particularly let's say every preliminary cost or pre-operative cost of running the organization, that will be put in by them, and sponsor will be particularly doing all these tasks on their own risk, right? Because if the registration is not successful or the transaction is unsuccessful, are going to lose their money, right? And further, if the transaction is successful, so they're having basically a huge risk associated with them, but in case they fail, they will lose the money. But in the case if they succeed, in case if they succeed, in that scenario sponsor receive the sponsors shares in the combined corporation. So let's say that particularly SPAC was there and particularly public entity was there. Now they all are merged on the combined company. They will be getting 20% of the shares, right? So they'll be getting 20% of the shares in that particular combined entity out there. Now sponsor purchases certain type of shares of the company at a nominal price, that particular shares which are basically purchased at some nominal price out there. So that is the scenario, right? Now let's have a look at the characteristics of the SPAC. Before that, let me tell you about the investors. Investors are those who are basically subscribing the SPAC. These are the public shareholders, and targets is actually related to company with whom they are going to be merged, right? So that's related to the different shareholders, stakeholders in case of SPAC. For this related to, let's have a look at the characteristics of the SPAC. So once the public offering is completed, after that the SPAC will be traded on the stock exchange as units out there, and further they'll be other than that they will be having the common shares. So they will be particularly be there on the stock exchange, and also common shares or the warrants out there, right? Now warrants are actually related to what? Warrants will be based upon the equity shares in that scenario, that will be giving a right to the, let's say, QA based, that is a qualified institutional buyers or particular other buyers over there. They have invested into the warrants. Let's say upfront they have paid 25% of the amount, and once the transaction is completed and they found that the shares are beneficial for us, they can be paying for the another amount, and for the they can be acquiring the shares at a strike price, at a strike price. Now strike price is generally a nominal price at which time the IPO related to SPAC were issued. Let's say case on IPO issue date, the SPAC share price was, let's say, 100 rupees. Now in that scenario the strike price will be 100 for the warrant purposes, right? Now after that it's related to, because of the liquidity in the trading market, investors have the right, basically they can be exiting their position, because once they have issued the shares and your company is traded in public, now the persons or the investors who have invested into the SPACs over there, they can actually be selling their shares, and ultimately they can be diluting their shares, right? And further, the corporation is obligated to provide the stockholders of the target business with full disclosure. So every disclosure is to be made, which basically include the comprehensive audited financial statements over there, or particularly the terms of proposed business combination over there. Those all will be made transparent, and this all every information will be available over there. And all the stakeholders of the SPAC are given the voting rights. So whatsoever the shareholders of the SPAC, they will be given the voting right as the shareholders. So in the meeting over there, so that they can be agreeing or disagreeing to the proposed things, like related to, I told you that SPAC is to be merged with some other company, with a target company over there. So the shareholders will be having a voting right, that whether they want to proceed with this merger or not. So on the case, let's take the case that they don't want the company to be merged. In that scenario, they can also be redeeming the shares. They can also be redeeming the shares, or they can simply be raising the world that we do not want that particular merger out there. Because I told you that they are given, the SPAC is given a time period of 18 to 24 months, and for the, let's say, if this process they are not able to find the target company, or they are not able to complete the transaction, that is a merger transaction over there, in that scenario the SPAC will be diluted. The SPAC is to be diluted and it will be liquidated, right? That was the main scenario. And further, Now, SPAC is actually led by the experienced management over there, and actually, it must be including at least three people who are having the expertise in private equity, who are having the expertise in merger and acquisitions over there, and further, they must be have played the operating roles in the different companies out there. And management team of the SPAC is entitled to receive these. This is actually related to what? This is actually related to sponsors who will be receiving 20% of the equity in the combined vehicle. In the combined vehicle, excluding they, that's actually related to common shares only. Other than this 20%, it may be the case that the people are also having the warrant so that they can be buying another set of shares also, right? Because warrant actually gives them a right that they can be having the extra number of shares at the strike price, right? And in the event the management team is actually unable to successful the business combination, okay, in that scenario, whatsoever money they have invested initially, that will be lost, that will be lost. And further, ultimately whatsoever the assets were belonging to the SPAC over there, whether we are talking about the trust funds which were actually formed when the IPO money was coming, or it may be related to another assets which have been obtained by the SPAC over there, those all may be liquidated and the money will be returned to the shareholders, right? Distributed among the shareholders. Further, it's related to process. Let's have a look at it. So SPAC is obligated to repay the funds to the investors after deducting the bank and broker cost. Let's say case the investment bank was there, management team was there. Now they will be collecting a fees which will be equal to 10% of the IPO amount, which was actually equal to 10% of the IPO amount. And for the after deducting this fees, whatsoever the money that was accumulating in the trust account over there, that will be distributed, right? And during an IPO, securities are sold at a price per unit that corresponding to one or more shares of the stock, common stock. Let's say case the securities were also sold. On one hand, the shares were issued in IPO, and on the other hand, securities were also issued, right? Now these securities will be issued at a price of multiple of one or more units of the shares. Let's say case one unit of the share price was at rupees 100, so it may be the case that the securities are being issued at 3 multiple of the share price or 4 multiple of share price, or whatsoever the scenario it is, right? And further, if the business requires additional fund, as I told you, they can get the funds through the pipe, or they can get the funds in the form of loan in the market, right? Further, the money obtained from the IPO is placed in trust account, as I've already told you. That's the main scenario. And now let's have a look at the SPAC capital structure. It's related to the SPAC capital structure. Now the funds are often gathered from whom? These are gathered from the institutional and the retail investors. So let's say case SPAC was formed. Now definitely retail investors can also be there, and also the money will be coming from the institutional investors. Institutional investors, let's say qualified institutional investors, or let's say case other case. Now they will be investing into the common stock, and also they will be having the warrants with them. They also will be investing into warrants so as to buy the shares afterwards at some convenient price, or let's say at a strike price. And after the IPO, the units can be split up into the warrants and for the shares of common stock, and for the can be sold on the open market. Now once the IPO is done, when the people have invested into it, now particularly after that, they will be having the units of the stock, and ultimately they can be selling the stock in the open market also after the same, right? Now after that, it's related to trust account. Now, as I've told you, that sum equal to or greater than 100% of the proceeds that are received through the IPO. Now, whatsoever the amount that you have received through IPO, 100% of the same or greater than that, that is to be placed where? That is to be placed in the trust account. That is to be placed in trust account over there. Now, roughly 95% of the funds are coming from the general public, 95% funds coming from the general public, and 5% of the funds will be coming from the sponsors. Okay, that is actually from the general public, and for the 5% of the funds will be coming from the sponsors over there. And the money in the trust account, that can be kept as it is, or that can be, because that will be vacant right now, and so that can be invested into the government securities or no risk bearing securities out there. And further, whatsoever money that will be earned through the same, that can be used for the working capital of the SPAC, or particularly whatsoever income, extra income that will be there if they're having any surplus, and if the SPAC is liquidated, in that scenario, that profit is also distributed among the shareholders, right? That's the case related it. And further, it's the case whatsoever the money lying there in the trust account, it can be used for what? It can be used for redeeming the shares of the shareholders, and further it can be used for the de-SPACing transaction, and it can be used for the working capital transactions of the SPAC company, right? Now let's have a look at the warrants over there. Now, warrants whatsoever are there are actually purchased by the sponsors. Now sponsors will be doing what? Sponsors will be purchasing the warrants in whole. They will be purchasing the warrants in whole, whereas the units offered for sale for the general public are of include only a portion of a single warrant, right? So whatsoever the units of the shares which will be available for the general public, those will be basically indicating a part of the warrants, and ultimately all the warrants are actually owned by the sponsors over there. And share price at the time of the first IPO, I told you, share price at the first time of IPO, that will be basically what? That will be the strike price of the warrant in general. That will be the strike price of warrant in general. And public warrants are typically settled in cash, and further the founder warrants are net settled. What do you mean by the founder warrants are net settled? It means whatsoever the strike price is there and whatsoever the difference between the fair value market price, fair market value of the share over there, that is going to be set. Let's say case if a sponsor is going to redeem a warrant, in that scenario the difference between the same is to be paid to the sponsor out there. In other scenario, let's say case if the general public are having the warrants or the institutional buyers are having the warrants, those will be settled in cash. That full amount will be paid, right? That's the main thing related to it. Further, it's related to IPO agreements. Now let's have a look at the different agreements over here. First of all, it's related to charter. Now charter will basically will be indicating what? It will be giving the full and fledged particular details related to the whole scenario, right? So document that actually establishes the public shares as well as the founder shares, including the anti-dilution modification. So related to whatsoever shares there are or dilutions there are, those will be indicated, and what will be the conversion ratio, that instead for getting one share particularly for one warrant, how many shares you will be getting and what will be the price of the same. Those all things are particularly indicated in the charter over there. And also it basically places a limitation. Okay, what limitation? That where the trust fund can be utilized. So it basically places a limitation on the funds which is actually placed in the trust account there, and also limit the application that where that particular fund can be utilized, right? That the fund can be utilized so as to repurchase the shares, for the redeeming the shares, or for particularly for de-SPAC transaction it can be used, right? That's all covered under charter, right? And after that, it's related to securities purchase agreement. It's related to the securities purchase agreement. In that scenario, whosoever the sponsors, I told you about the stakeholders, so the sponsors were there. So sponsors among with the SPAC, they will be coming under what? They will be coming under a securities purchase agreement, that is SPA. They will be coming under a securities purchase agreement, and further which provide for the issue of founders shares or to the sponsor of the SPAC over there. Okay, so number of founder shares is typically set at 25%. So it is particularly the number of shares will be ranging from 20 to 25% of the public traded shares, and initially registered as a registration statement out there. And for the number of founder shares may be decreased or increased through the stock split or dividend or even cancellation of the or the forfeiture of the same, right? So securities purchase agreement is actually between the sponsors and the SPAC, where it gives a right that sponsor will be having shares of 25% of the total number of the public traded shares, and further they will be having the sponsor number of shares can be increased, decreased, or particularly they can also be forfeited, right? Further, it's related to warrant agreement. It's related to the warrant agreement. So the SPAC and the transfer agent, so the special purpose acquisition company, and further the transfer agent, they will be signing what? They will be signing the warrant agreement. They will be signing the warrant agreement, which basically will be outlining all the parameters related to the warrant out there, that when these can be redeemed, what will be the strike price and everything related to it. And further, the SPAC will be having the obligation that the SPAC is to particularly comply with the issuance of the shares over there, that whatsoever when a particular warrant is exercised, in that scenario the SPAC will be having the obligation that it has to issue another set of shares. It has to issue another set of shares as per the agreement between the transfer agent and the SPAC out there. Okay, so that is to be done, right? And further, to change the conditions of the warrant agreement, if somebody wants to change the conditions of the warrant agreement, at least 50% of the share warrant holders particular approval is required if you want to change the terms and conditions of the same. Otherwise, that agreement is between the SPAC and particular transfer agent, that whatsoever the conditions related to the warrant agreement, those are to be complied with, right? Further, it's related to promissory note. Now SPAC actually do not have any kind of funds just to start the business, initial expenses, right? So SPAC is actually a blank check company. It is not having any kind of funds with it. So promissory note is actually related to between the sponsors and the SPAC. Now sponsors particularly say what? The SPAC is actually promising the sponsors that it will pay the debt. So it will pay the debt whatsoever the amount which has been spent as initial expenses by the sponsors out there. There is an agreement, that is a promissory note by the SPAC out there, that it will be repaying all the debts. It will be repaying all the debts to the sponsors over there, right? So the sponsors agree to engage into a promissory note with the SPAC in order to lend the funds to the SPAC over there in form of loan until the completion of the SPAC's first initial public offering, right? So once the public offering is done, after that the amount of the sponsors which they have spent initially, that will be repaid back to the sponsors with interest, right? Further, it's related to sponsor constituent document. It's related to the sponsor constituent document. So in that scenario, a new LLC, that is a limited liability company, is established for the sole purpose of acting as a sponsor for the SPAC. Now in that scenario, what happens, that sponsors will not be basically counted as for a individual entity out there, but they'll be forming a LLC, that is a limited liability company for the same, and further they'll be becoming the directors of the same, and this LLC will actually be investing into this company, that is sponsoring this particular SPAC out there, and that is the funda related to what, that sponsor constituent document over there. Now the owners of the sponsor, now this is actually what, this is a sole sponsor. This is a sole sponsor, and let's say A, B, C are the directors, and these are the owners of the limited liability company. These are the owners of the limited liability company, right? Now they will be having a relationship with one another and the relative participation in the SPAC in writing out there, and they specify the proportionate amount of founder warrant purchase price, right? At what price they will be purchasing the warrants out there, and further all the things related to it. Okay, so that's particularly agreement between these two, that is the sponsor and the SPAC over there, and for that particular purpose a new LLC is actually established, right? Further, after that, it's related to the letter agreement. It's related to the letter agreement. Now SPAC actually will be reaching a letter agreement with its officers, directors, sponsor before moving forward with the process. So once the SPAC is to move forward with the process out there, it has to basically reaches a letter agreement with the same, and whatsoever the lockup agreement is there, whatsoever the indemnification related to the same, for its voting agreement obligating to the officers, directors, sponsor over there, that they will be giving a positive note to the de-SPAC transaction, that they will be giving a positive note to the de-SPAC transaction. That will be a letter agreement that will be signed between the SPAC and whatsoever the key authorities, key persons of the SPAC over there, right? And further, it's related to registration right agreement. That's related to the registration rights agreement. Now for the benefit of the sponsor, let's say case there are sponsors, and here we are having the special purpose acquisition company. So for the benefit of the sponsor and for the other holders of the founder shares or founder warrants over there, the SPAC enters into a registration rights agreement granting the sponsor and other such warrant holders or the shareholders, they will be getting the registration rights. They will be getting, so the sponsors plus the warrant holders plus we can say the founder shareholders, they will be getting what, they will be getting the registration right with the respect to the founder shares or founder warrants or founder any other equity that is actually held by the sponsors out there. So that particular agreement will be between the SPAC and the sponsors out there related to that. They will be having the right of registration of these particular instruments, right? That's a registration right agreement. And after that, it's related to private placement warrants purchase agreement. Private placement warrants purchase agreement. Now in terms, in accordance with the private placement purchase agreement, it is signed between the SPAC, the sponsor has agreed to purchase the founder warrants. So SPAC actually will be selling the warrants to the sponsors, of own, and further there will be an agreement related to the same. There will be an agreement related to the same where the sponsor has actually been agreeing so as to purchase the founder warrants, that they have actually agreed that they are going to purchase the founder warrants. That particular agreement between the same, right? Now financing the purchase price occurs one business day before the conclusion of the IPO. So when the IPO is to be concluded, T-1 day, when the IPO is concluded, on the T-1 day, and further before the closing of any exercise of the green shoe option over there, this particular this particular option is to be executed, that the sponsors are to actually purchase the warrants. Sponsors are to purchase the warrants over there. Now, green shoe option is actually what? Green shoe option actually allows the group of investment banks that actually underwrite an IPO to buy and for the offer of for sale 15% more shares at the same offering price than the issuing company originally planned to sell. Now, what is actually green option shoe? Let's understand this with an example. Let's say the case that IPO is being offered by SPAC and for the unit share price is rupees 100. And for the let's say case that there is an agreement between the issuing company, that is SPAC over there, and the underwriter companies over there, that's these are actually the merchant banks, that if there is under subscription in that scenario, let's say underwriter is saying that they are going to purchase 5% of the shares, right? That is the agreement between the normal agreement, that's the underwriting agreement, right? But in the case of the green shoe option, the group of underwriters, they will actually be purchasing 15% more. They will be purchasing 15% more shares at the time of particulars at the same offering price, at the same offering price of the issuing company where they are basically planning to sell. They actually be investing 15% more, right? That's actually the case related to what? That's the green shoe option. Okay. Further after that, it's related to securities assignment agreement. Securities assignment agreement. Now, compensation for the independent directors. Now, let's say there are independent directors. There are independent directors, right? Now, the compensation to the independent directors is actually provided by the SPAC. So, the SPAC will actually be providing the compensation to these independent directors in the form of cost plus sale of founder shares, right? So, whatsoever the cost plus founder shares, they will be offered to the independent directors over there. They will be paid to the independent directors, and this is the only method that how the independent directors can be receiving their remuneration. Okay, so that's actually related to securities assignment agreement, and after that it's related to administrative service agreement. That's related to the administrative service agreement. Now, monthly charge is actually paid by the SPAC to the sponsor. So whatsoever the sponsors are there, let's say case that there are sponsors, and sponsors will actually be receiving a monthly charge. Okay, in exchange for the sponsor will be providing, the sponsor will be actually be giving the another things. Let's say case office space is given, secretariat support is given, administrative services is given. So many services are being given by the sponsors out there. So particularly a monthly charge will be paid by the SPAC to the sponsors. That will be paid by the SPAC to the sponsors over there. That's actually the administrative service agreement. That's we are receiving the services from the administrative services from the sponsors, and in further in exchange the SPAC is going to the monthly charge for the same, right? And for the SPAC makes use of the regulations in the process of its formation of the this particular administrative service agreement over there. So no excess amount is paid, and after the IPO it will also sign into investment agreement management trust agreement with the trustee over there, right? And after once the IPO has been issued, so SPAC will also be signing another agreement, that is the investment management trust agreement with the trustee of the trust, which is actually created where the funds of the IPO are placed, right? And further this agreement will control the investment. So whatsoever the investments are to be made by the SPAC over there, this agreement will be controlling the same, and in accordance with the same, the trustee will be actually the trust account will be giving the money, right? And further after that it's related to the de-SPAC process. Now, what is the de-SPAC process? It is to be completed within a period of 18 to 24 months. Once you have finalized the target company, you are to basically get approval from the shareholders, and further after that the approbation votes are to be given related to that the target is to be done, and ultimately the particular combination of the entities will be done, and within 4 days after the transaction, form 8K or super 8K form 8K is to be submitted with the SEC, that is a US SEC, that is a United States Securities Exchange Commission. Okay, that is to be done, and further after that it's related to redemption offer, that whomsoever investors who have actually invested into the company, because the shares are not publicly traded, now they can be selling their shares in the market out there, right? So as to basically get the money, right? That's the main funda. So first of all it's related to what? It's related to the shareholders approval. So the buyer in this case of SPAC needs to get approval from the shareholders that they want to go along with the company merger over there or not. Further, it's related to founder vote requirements. Now, at the time of the IPO, founder shareholders like the sponsors or other shareholders, which are the founders over there, will make a commitment to vote in favor of the D-SPAC. I told you about this agreement, no? There was an agreement related to the same, that is actually letter agreement, that they will be positive in favor of the D-SPAC transaction over there. We are talking about that particular agreement, right? And for the at least 20% of the outstanding shares of the SPAC will be committed to the voting in support of the D-SPAC transaction. As a result, just 37.5% shares are necessary to accomplish the goal of majority vote, and so as for the approval of the transaction out there, right? That's the main thing. And what do you mean by redemption offer? That once your particular shares are public, let's say case there was a SPAC company and particularly there was a target, now though both are combined, and for further the units are after that, because it was a public entity, now your units are publicly traded. Your units are publicly traded. That's the main fundamentality. Now it gives actually the owner of the public shares the option to exchange those shares for proportional shares of the profit stored in the trust account over there. Now the particularly redemption can be two ways. Let's say a SPAC was just formed, but some of the particular shareholders are saying that they want to go for the merger over there. They can be redeeming their shares. So the trust where the funds were kept over there. So if they were generating any of the revenues, they can be those particular revenues can be used so as to buy back the shares for the redemption of the shares over there, right? Now, redemption offer will not be valid for public warrants. I'm telling you, this will not be valid for the public warrants over there until such time as those warrants are either exercised, exchanged, or otherwise voided in accordance with the terms of usage, right? So particularly if otherwise you're going to redeem the warrants, that is actually not going to happen. And further, only that can be done only when the rights are exercised or something like that, only then it can be done, otherwise it cannot be done. Okay. And further, if the time limit to finish the SPAC transaction passes, like I told you that you are having 18 to 24 months when you are to do the D-SPAC transaction, if that particular time passes, then it will be required to redeem the public shares in proportion of the shareholders, right? That is to be done. And for if the D-SPAC transaction does not go through, if does not go through, so what's of the money that is lying in the trust account, that is to be given back. That is to be given back. But the public warrants, founder shares, founder warrants, they will lose their value in that scenario if the SPAC is diluted. I told you that if the transaction is successful, then particularly sponsors will be getting the benefit, 20 to 25% sponsor shares, and for the sponsor warrants, sponsor shares are given to them, right? But if the transaction never goes through, in that case, those all will be getting devalued and they will be getting nothing, right? So that was all related to the D-SPAC transactions and all about it. So what are you waiting for? Just do enroll right now. Just don't sign up. We have to basically visit to our website caiib.learningsessions.in. Simple website, that is caiib.learningsessions.in. Simply visit this website and further simply sign up over the same, which is absolutely free, and navigate to the PDF section so as to get all the PDFs out there. I hope that you must have enjoyed the content of this particular video. So do hit the like button if you have liked the video, and if you're having any suggestion or feedback, you can let me know in the comment section below. Definitely I'll be reverting to you very well and very soon. So hoping that you must have enjoyed, and further, as I told you in the beginning of the video, that you can be finding each and every content related to all the papers of CAIIB on our website and through the iOS and Android application. Do find the link in the description, and also it is iibf.info/CAIIB where you'll be finding each and everything. So see you again tomorrow in the next video.